Hey there, my name is Chris Vermeulen, the Chief Investment Officer at the Technical Traders, and I want to give you just a real quick snapshot of really what makes a difference in the strategy that we trade, the consistent growth strategy we call CGS. So take a look here, and I want to cover the number one problem that investors need to resolve, and I'll show you how we do that. So let's jump right into problem number one real quick. What to own during falling stock prices? Well, pretty straightforward. Why it's important to own rising assets. First off, the key here is it creates the stability. No more riding things down. This way you've got no more big peaks and valleys in your trading account, in your mood swings, all those things. And then, of course, it's going to free up your time to work on other projects, because when you've got something consistent, it becomes clockwork. You don't need to spend a lot of time on it. You just put your time in when and where it's needed and then go do other things. I've done a lot of different things. I own a lot of different businesses, self-storage facilities, invest in a lot of different companies. I've built the world's first electric flying jet surfboard, which I've patented and licensed out. So I'm also part of the 100 Men Who Care. We started this group of 100 men. We donate $100 each, and there's 100 of us, and we try to donate $10,000 to a local charity 4 times a year. So lots of amazing stuff when you have time and money on your hands here. And of course, it's going to allow you to spend quality time with your family. So that's the benefit of holding rising assets. Everything just goes in your favor. Now, how to select the correct asset? Pretty much we want to just follow our hierarchy of growth to cash positions. And I'm going to walk you through those ETFs here shortly. And then we want to select the top asset that's in a bullish trend. And then we want to execute those positions and follow the trading rules. It's pretty straightforward. Have your rules, find the best asset, execute the trade, rinse and repeat. So here is the hierarchy of positions. Now there's only 5 here, but we trade the QQQ as well. And it's a very powerful part of the strategy. But the hierarchy is the stock market. I believe U.S. stocks have the best opportunity, the best volatility, the best liquidity. That is always our core position. We want to be in stocks whenever there is a buy signal and hold that position. And then we look at long-term U.S. treasuries, and then we look at the dollar ETF, and then we look at the inverse dollar ETF. So even if everything is falling, including the dollar, we can still make money while we're more or less sitting in cash. And then if none of those are in favor, we move to bill, which is a 1 to 3 month treasury note, and you just generate interest on it. Now, this is really important, and this goes against the general grain of everyone else here. So typically when there's big volatility, people want to get more active and they feel like they're missing out and they should be making more money and all those things. And they have a very wrong mindset of, in my belief, of how to attack the markets. Now, when volatility increases, you want to actually get away from it. Volatility is dangerous. It is, especially when you've got a large sum of money. You don't need to go giving back huge chunks. So this Donchian 20-day Donchian percent volatility here's telling us that over the past 20 days, the SP 500 from the ultimate high to the low within that 20-day window was 14%. For bonds, it was about half of that. And then the US dollar was about half of bonds. And then bill, it was just a very low volatility. So as things get crazy, we're moving down our hierarchy away from volatility, looking for something more stable and preferably something that is trending up. Now, I also like to quickly look at the 20-day daily percent range. This is telling us over 20 days, the S&P 500 moved about 2.5% every day. So lots of volatility. And then, of course, we got 1.75% for bonds, 0.75% for the dollar, and a little bit for the T-bill. Now, this was during a pretty high volatile time when I took it, but it still runs the same in almost all scenarios. Volatility declines as you move down this list. And then the other thing here is we want to take a look at the correlation. Anything plus or minus up to 0.3 is a neutral correlation, meaning it dances to the beat of its own drum. Stocks could go up, these things could go any direction they want. And so we want to make sure things aren't related. Now these will fluctuate, but that's just part of how the markets move. And then of course we want to find something that is in a bullish stage. We only want to trade things going up. This year has been the dollar. And that's been the strongest play. That was our most recent trade, getting into the dollar, making money while the market collapsed. And so that's how we kind of attack the market with this hierarchy of positions. Now the bill, if you don't know what it is, it's just like putting your money in cash, more or less. You're more or less just putting it in a T-bill, generating some interest. And this is showing you over 1 month the returns by just sitting there and getting paid the dividends. It's slowly working its way up. You make 0.2%. Sure, it's not a whole lot of money, but you're at least making money when you're sitting in cash. And if you got a $100,000 account, it's $200 for sitting on your hands. Better than nothing, not much, but it is better than nothing. If you got $1 million account, it's $2,000. If you're, a large firm, $10 million, you're looking at $20,000 for sitting on cash while the stock market falls 10%. Not a bad scenario. And this is one of the keys here. Cash is king. It always has been during certain market conditions. And a lot of people just hate cash for some reason because they think they need to be active, but we do not believe, and we look at cash as an amazing position. So here, let me give you 2 scenarios of how these trades unfold. So this was the COVID crash, and this was a pretty amazing opportunity. Naturally, we're going to be in the top ETF. This is the SPY, the US stock market. And then we got bonds, UUP, inverse dollar, and then T-bill. This is our hierarchy. And everything's squished down, so you don't really get to see the full trends, but I've drawn in the percentages. So more or less, we're long the stock market. And then we've got a sell signal on the stock market. So we have to go to our strategy and say, okay, which one is actually giving us a buy signal? Which one is trending higher? Which one is the best asset? Which happened to be the TLT bond. And we actually caught a beautiful 19% move in bonds. This was before COVID. I mean, it was already taking place, but nobody had a grasp of how bad things were. We caught a huge move while the stock market moved down. And then after that, once it hit our targets and an intraday trailing stop kicked in automatically to kick us out of the trade and protect us, we moved over to bill into a cash position until the stock market gave us a new buy signal. We got back in. It's hard to tell, but this is actually a very, very strong rise in value. It's just this was a 30% collapse, so the whole chart is squished flat. But we got back in at a near 13% discount. So imagine making money, you take your profits, you grow it another, up to 20%, and then you move to cash, earn a little bit of interest, and then move back into the stock market where you originally were, but at a 13% discount, and then ride it up even higher. If this doesn't excite you, if you don't see the value in this, you don't have a heartbeat, because this is unbelievable. And this is where we're literally compounding our growth, compounding new growth, compounding it. It is super powerful. I don't know why people haven't done this. This to me is the best strategy. I have gone through the whole wheel of trading stocks, options, Forex, futures, you name it. I've tried every strategy over the past 25 plus years. And by far, trading the big assets, playing the big waves, the flows of money and the emotions in the markets, and just rotating and managing our risks and positions, we can just kind of dance around this market and have very, very above average returns and very low drawdowns. So very exciting times in the markets here. The more volatility we get, in some ways, it's actually even better. It creates lots of opportunity. So here we are again. Here's a scenario for this year. It actually ends in July. I haven't updated it, but we've got the stock market. We're long stocks. It rolls over. We get a sell signal. We have to figure out which strategy is the best to get in, which asset, which happens to be UUP for this year. UUP continues to rally. Now, bonds have been trading down pretty much the day we got out of bonds in 2020 was the day it put in a top. And it's been useless ever since and out of favor. So we move into the dollar, and then the stock market gives us another buy signal. So no matter what position we're in down here, if the stock market gives us a buy signal, we get back into the stocks because I believe they're the best opportunity, and that's where we want to go. So we ended up having a small gain here, and then the market gave a sell signal. We had to go back. Got back into UUP, which continued to go up while the stock market crashed. And it fell 13% while the US dollar rallied 6.5%. So really, really powerful. And of course, if you were to just buy and hold just in plain old cash, you could still earn interest in the bill ETF going forward. So here's a quick view of the CGS performance compared to the SP 500 and the 60/40 portfolio, which most people generally have a general blend of. The strategy here of CGS is just kind of up and to the right, rally, pause, rally, pause, rally, pause, where the stock market can go into a full-on bear market, have multiple big corrections and crashes along the way, and definitely hinder the returns and create a lot of emotions. So this is what we want to do. We just want to be consistent up and to the right, and we're either in something going up or we're in cash, which is still inching its way up. So we're always pretty much in something rising in value. And that's where we really stand apart from everyone else. I do not believe in holding something going down in value for any length of time. It defeats the whole point of us trying to make money. So I don't know why people want to hold on to assets going down. It really boggles my mind. So here's a visual graph of the performance. So here's CGS. Year to date, we're up almost 3%. Inception for all three of these have the same start date back in 2007. And then you can see the max drawdown. Now this is where I think people should actually get really excited here. Is the SP 500 had a 53%, the 60/40 portfolio had a 38% drawdown. Where our strategy, because we're always moving into something rising, and we're splitting our portfolio up between indexes and have very tight position management rules, we have a very small, less than 6% drawdown. And that, I mean, is really priceless. You know, from our biggest drawdown, 6% means you're pretty much right up near at a high watermark. Some years are absolutely amazing. COVID year was the best year ever. And then of course, the worst year was a 2% gain. And there eventually will be a year where we probably take a loss, but we're not looking at anything substantial. And that's what we want, is just a consistent growth, whether it's 2% or 50%, it doesn't matter. Growth is growth. And you want to be able to withdraw from your funds and not worry about, running out of money when you get older. But if you withdraw funds when you are 30, 40, 50% drawn down, you will run out of money eventually unless you change your lifestyle and downgrade your spending.